Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Christos Makridis. He is senior researcher at Gallup and Associate Professor at Arizona State University. Carter Razink, co-founder of Spree Finance. Knab, founder and CEO of Franklin. And Edward Woodford, founder and CEO of Zero Hash. We're here to discuss why stablecoins are poised to play a central role in shaping the future of the global capital markets. One of my favorite topics that we discuss here on Trade Talks. Christos, it's great to see you again. Welcome back to the show. Give us some insight, some of the work that you're doing at Gallup.
Well, thank you so much, Jill. It's great to be back. One of the things that Gallup cares deeply about is measuring and understanding people. How do people think? How do they develop? And that involves financial assets. And so we've been surveying individuals, understanding their preferences for different types of asset classes. So what do people think about Bitcoin, Ethereum? And so one thing we've found is that it can vary by year. So in 2022, about 8% of people were ranking Bitcoin, Ethereum, et cetera, as their top investment. In 2023, when the market changed a little bit, that went down to 4%. And so I think what we're seeing today, and what I'm really looking forward to the conversation about, is that there's this growing maturity that's happening in this sector. And so it's not going to just be this volatile asset class, but really understanding what do people think, and what types of assets are going to be best for them, and what the implications are for the nation.
And Carter, that's the vibe that you and I experienced at Consensus in
Absolutely.
Toronto just a couple weeks ago. Before we get into the maturation of this space, tell us about Spree Finance. What's your role?
Yeah, no, thanks for having me. It's excited to chat and have a great conversation here. It's funny, we're talking about maturation. Spree's building the infrastructure for the future of stablecoin rewards and commerce, right? It's funny, we talk about, I use my credit cards, I get points. I'm effectively using rewards points that are cryptocurrencies or digital assets today, and they're siloed. It's like a private central bank currency, right? So really what we're trying to build at Spree is the next step of what we believe to be, we talk about we're at the 8-figure 50 to 100 million. We're trying to get to the 500 to 1 billion step, and we believe that rewards is that next step.
Which is interesting because this was the first year covering Consensus, and I've been doing it since 2018, where we weren't just talking about financial services.
Absolutely.
And I thought that was really encouraging. Megan, tell us about Franklin.
Sure. I started up Franklin about 3 years ago, trying to help businesses be able to operate more natively on-chain. We do that by offering on and off-chain payroll processing for businesses primarily based in the United States. It's been really exciting to see the market sort of warm up to stablecoins over the past 3 years. And it's really, interesting to think about how business models will change as money moves much faster instantly, and how all the things that ripple out from business operations, like how you pay and incentivize your team, your vendors, things like that, will change.
Which is interesting because Carter and I just made that point that it's beyond our own payroll and human resources, which I think is interesting. Edward, tell us about Zero Hash.
Yeah, so we've been building since 2017, and we're an infrastructure provider that powers a bunch of different use cases across, for example, traditional financial services, so some of the largest brokerage platforms, and for example, Bitcoin, such as Interactive Brokers. We power a bunch of different payment use cases, Stripe, Shift4, Nuvei, all leverage us for different products, including things like payroll and other mechanisms. And then more recently, we've been powering stablecoin on and off ramping to tokenized funds. So that includes BIDL or Franklin Templeton's Benji token. So we're that infrastructure layer that abstracts away the complexity for some of the largest institutions out there to adopt this, what is fundamentally a technology versus a standalone asset class.
And Christos, let's expand upon that because, and remove ourselves just from institutional adoption here. Stablecoins are considered the next frontier of economic competitiveness. We somewhat understand what that means from a global capital markets perspective, but what does that mean for us, the people? What do we get out of it?
Yeah, I want to make 2 points here. Number one is, I think the easier one, that as more people are holding stablecoins, that's going to boost the value of the dollar, because by definition, a stablecoin is a one-to-one peg with the dollar. And so the more that stablecoins are throughout the United States, the more that that's going to kind of bring benefit for the U.S. consumer and the United States as a whole. The more that impacts our ability to do diplomacy and so on. The second point that I think is maybe a little harder to see, and let's see if we can get to it over the course of the conversation, is people talk about digital twins and AI. Well, stablecoins are actually one of the first manifestations of that. Why? Because they're a digital rendering of the dollar or of the euro, but mainly of the dollar. And so as we think about projecting U.S. competitiveness and being able to create digital renderings of the United States economy, stablecoins are doing that. And if we can do that reliably across all types of assets, if we could tokenize every asset and have a digital rendering on the blockchain, we can start doing really high fidelity simulations to understand what prices, what's happening to prices in real time. And so that actually counters inflation, because why does inflation happen? There's uncertainty about price movements. There's inability to track. But with tokenization, which goes back to Edward's point, with tokenization, you start solving that. But that's a bit of a mouthful. But I think in a nutshell, it's like this helps the United States really advance the dollar. And
well, look, we were talking about this off camera, but once we get this legislation through, when it happens in the U.S., it happens at scale, right? I mean, it's great to see that other frameworks have been developed around the world. It's a great start. But for scale, it's going to need to happen here. Carter, you and I were talking off camera where it feels as if the accessibility and democratization story, it's not just a story now, it is happening. And I think that's important because sometimes those two words get thrown around a lot.
Oh, absolutely. And it's funny, you know, you talk about this idea of effectively power projection, right? And I think that there's really two compelling narratives coming together at the same time. We have the military and we have these other physical manifestations of power projection. We have the media to push information power projection. Stablecoins are the digital power projection through economic means. And so on one hand, we have all of the economic force and the might of the United States and the US dollar. And then on the other hand, we're at this really fascinating time in the world where, for the first time in digital asset history, people are looking at crypto as a mechanism to use money in ways that we've never thought about. And so we talked about this idea of earning points, right? That's commerce. People use commerce all the time. But we're to the point where we're building new technology that is a 0 to 1 step change that has the capacity to onboard, you know, my grandma and my aunts and uncles who really, they hear crypto and they're like, have fun, right? That's not really for me. And we have the Bitcoin ETF. These are risk-on players that are thinking of Bitcoin as an asset that's going to appreciate. But I think stablecoins have the capacity to onboard people who use dollars and improve all forms of dollar movement.
Right. Okay, well, let's even take a step back and make it more digestible. There are a couple billion people around the world that don't have access to legacy banking.
Totally.
However, they have leapfrogged and they're leveraging this type of technology, blockchain and stablecoins. One, to protect against inflation.
Absolutely.
Cross-border commerce, growing,
Remittance,
you know,
all
alternative forms, right, of capital. And for example, what if you want the safety of the U.S. Treasuries? Now you can access it through a stablecoin, which is not as easy for people to do overseas in a market like the Treasury. So it's building generational wealth potentially. Let's talk about how it has impacted an industry like payroll. What have some of the benefits been?
Yeah, I mean, I think to your earlier point, some of our customers, and I know companies that use stablecoins are most excited about them for international remittances. So you can hire great tech talent that may be in an economy that really wants exposure to US dollars. So we see a lot of that. For us, operating primarily with US-based companies, we look very specifically at the payroll industry where fund flows are quite long. It could take 5 to 7 business days to settle payroll. Payroll processors are locking up business cash. You have new kind of fancy programs like earned wage access, which is basically just modern day payday lending. And so for us, we're very excited about the idea of the programmability of stablecoins, where a paycheck could have up to 250,000 permutations. It needs to get split up in 10 to 12 different ways every pay cycle for every person. And stablecoins are a great technical solution to that issue.
Yeah, Edward, do you think it will remove some of the cross-border and jurisdictional challenges that arise when you have to operate in multiple regulatory environments?
Yeah, I mean, I think what's really interesting about payroll in particular is the way that payroll actually works, right? So a company will approve a payroll wire on a Wednesday that is fundamentally impossible to pay people in 100 plus different countries. That's the beauty of stablecoin, is that it's instant and real time. Not paying your employees on time is not acceptable. So that's what a stablecoin unlocks. I think cross-border is a particular point. I think it also, leaning on your point around changing the paradigm through the power of stablecoins. If you think about what stablecoins can do by reducing the cost, that can be very meaningful for a large percentage of people. So you mentioned payday lending. Payday lending is effectively earning wages that you've already been paid. We all effectively, you think about the paradigm of work, we all effectively provide a loan to our employer. That's what a cycle of payroll actually is. So when you lower the cost of payments, when you make it easily programmable, and that's the promise of stablecoins, is it's cheaper and more easy to use in a programmable way, you can start to pay people more quickly and at lower increments. So that could be daily, that could even be streamed payroll. And so when you think about what payroll actually is, this could be global payroll companies, this could be some of the largest two-sided marketplaces such as Upwork or Replit. And you spoke about the power of stablecoins. I fundamentally believe that the next large global business, whether that be the next Uber, the next Replit, will be foundationally based on stablecoins because you abstract away the complexity and you make payments instant without having to go by this jurisdictional by jurisdictional element and allow people to be paid instantly, real time, and cheaply.
So how does that work, Megan? Does it go directly to your blockchain or personal account, or is it from, how is it distributed?
Yeah, I mean, I think different players do it differently. For us, we are a little bit more on the crypto native side. So our customers are actually running self-custodial payroll. They're interacting with a smart contract through our app, and then we're never actually touching any of the crypto. We're really more functioning as a tax engine and the filing service. And it's been fascinating seeing these faster pay cycles and these new innovations like streaming payroll. The IRS and New York State Labor Department don't have a method for you to actually be able to report wages in that way. So it puts a lot of pressure on the rest of the tech stack and labor policy.
I'm glad you brought up the tech stack.
Yeah.
Because Christos, I'm passionate about this space, but the technology is evolving way quicker than frameworks are being put into place. And the vulnerabilities that it opens us up to, whether you're thinking national security, traditional cybersecurity, privacy, and so forth, how is that being approached? How is the industry? I feel like the industry, as we saw a consensus, is just starting to really think about this.
Yeah. Well, I mean, as you were saying before about the Genius Act, so I have an op-ed out today in Real Clear Markets that makes the point that the Genius Act should only be kind of it's a step in the right direction, and it's going to hopefully get other countries to also start thinking alongside us, and this it allows the market to mature more and more, and then different agencies develop different standards in partnership with private sector. Because any time that a regulator tries to be one step ahead, I mean, it's an impossible battle. So the right way to do it is you start the guardrails, and then people from industry start adopting and building some of the decentralized standards that take root. So I think the Genius Act is going to be a step in the right direction. But then more to your point about what vulnerabilities are being created, we have to be extremely discerning and honest with ourselves, because we're not going to fool anyone by having 1 or 2 years that are great, but then you're creating vulnerabilities down the road. And so one of my other research papers with Tim Liu and Eric Gallenkin, we're looking at Fortune 500 companies, and we measure the number of ports that are vulnerable within their network. So let me kind of skip to the chase and basically say, for these Fortune 500 companies, we're finding that actually the median firm is incurring about $89 million in damages every year. Every year they're losing value because of persistent vulnerabilities. And so I think one of the takeaways is that this isn't a reason not to adopt digital assets. Rather, it's a reason to start getting real about basic business practices and adopting them. And even before the panel, we were talking about a DAO that has basically kind of gone defunct since the past couple of years. And it's like, I mean, it didn't need to happen. There's no rocket science that needs to be invented. We just need to start adopting basic best practices, have integrity. And so regulatory clarity will help move us in that direction. But we can't forget the vulnerabilities.
Yeah, if I may, I think broadly the US thinks about regulation by finding a throat to choke with Sarbanes-Oxley, with certain areas of securities regulation. And one of the innovations around crypto is this decrease of middlemen in between fund flows. And so ultimately, I think that's the best form of security, where you are yourself relying on your own personal security.
Well, I mean,
but certainly there must be standards.
Yeah, but regulation by enforcement doesn't work because then you don't understand how to work in that environment. It might not be malintent, but you just don't understand what the guardrails look like. Let's ask, an infrastructure practitioner, of which your company is. Are you thinking cyber first, privacy first by design?
Yeah, I mean, that's what we provide our customers. So we abstract away the complexity of both the cyber elements as well and the security of signing transactions on chain. If you think about this entire space, there's obviously the cyber and security elements, which are obviously front of mind as you start to think about banks and large financial institutions that we service. But really, I think we're now at a point in the stablecoin story where we have this distribution. If you look at where we are, some of the largest companies in the world, Revolut, Nubank, you asked to your point around how do you actually get paid in stablecoins. Most people now have access through a primary account, PayPal, another example. So effectively, the user experience is abstracted. I think you have now got this distribution of this technology, which makes it incredibly powerful. But not only are the cyber elements and the security elements around, if you think about self-custodial, but it's really the usability story. So really, I think there's going to be two resulting factors of the Genius Act that people aren't talking about. One is there's only going to be more stable coins. And secondly, there's only going to be more stable coins on more chains. What does that mean for the user? That makes it a more complex and fragmented experience. And so I think for the last 7 or 8 years that we've been building Zero Hash, we've been focused in terms of distributing this technology to make it really, really simple. And now the next 10 years are going to be solving usability challenges, which include abstracting away complexities, but also abstracting away the user experience, which is, I want to send you a stable coin. How do I do that easily, simply?
And this is super interesting because like with what I'm working on with my team over at Spree, we deal with commerce all the time, right? And one of the big attack vectors, as you bring up, is yes, the settlement is significantly superior, but if I use a credit card, I have chargeback recourse. So that's something that I think behaviorally within the world, but for sure in the States, is I spend a credit card, if I get scammed, I can go to my bank or my issuing partner and say, hey, this is an issue. So that is baked into that experience. Currently, without some additional hand-waving smart contract work, chargebacks is not baked into the stablecoin technology. And so that's a usability challenge that we need to solve. Thankfully, Circle just recently released almost like an escrow-based transaction flow where almost if you go on Venmo and say, hey, this is for goods and services, you'll have that same user experience when paying with stables. Right. And there's a mechanism to go back and get that same Web 2, regular credit card user experience within the Web 3 space. And what I'm working on at Spree is I'm trying to make that extremely simple to use. So the only way we get to that point is if we really distill the solutions down to a product that people don't really know or care. Right. It's dollars.
Which is so interesting because as we're talking about maturation in this space, and again, having covered this for nearly a decade at this point, again, at Consensus last year, it was a big turning point in my mind because user experience was one of the biggest topics. You want it ubiquitous. People don't care how you get from A to B as long as it functions and they're protected. And I feel like the ethos of design engineering versus them, it's not going to work. You need the innovation, you need the scale, and you need the safety, right? Totally. It all needs to come together. And it's not going to be perfect, right, Christos? I mean, there are vulnerabilities in equities and cash markets. It happens, but we should learn from these experiences as we think about formulating design and policy going forward.
Yeah, no, I mean, that's exactly right. And I think, I mean, 2 points here is number one, I think this is why rewards play a kind of integral role because you're able to kind of gamify the experience as well and to offer carrots for people to improve their financial health, their financial knowledge, because there's going to be more responsibility on all of us in this kind of new era instead of kind of outsourcing it to a centralized entity. And then the other thing that's really beautiful about digital twins, digital renderings of physical systems, is that you can be a lot more proactive in dynamically forecasting threats to the system before that they happen. So the more that we tokenize things and have these digital renderings, the more that we can actually build really high fidelity forecasting models to understand what sort of threats are actually entering and then detecting them real time and doing something about it instead of like in the Coinbase situation finding out kind of after the fact. So I think there's a lot of opportunity. We just have to be very vigilant of the vulnerabilities that are.
And we also do have to be accountable, right? Yeah. I mean, these frameworks are designed to protect consumers, but I also think it's incumbent on the industry to provide that education and for consumers to take care of their financial impact more directly. We have a minute and a half to go, and I want to get both of your inputs on this. When it comes to the technology that's being adopted in payroll, what does the next 3 to 5 years look like? Is it going to be a generational shift?
Yeah, I think that the payroll industry is going to be very dependent on other areas of commerce. If you are not recognizing revenue as quickly as you can't pay out people as quickly, instantly or stream them payments. So I think that it is, a niche and maybe like a very forward-looking part of financial services tech. I think it's going to take a little bit of time, honestly. I think like these other areas of the economy have to catch up. But I think 3 to 5 years, it'll be much more normalized to not be giving your employer a 2-week interest-free loan on your time.
But I mean, we're going to bring that up next time I have my review. That's amazing. Yeah. So Edward, to wrap up here, it seems to be the trend, right? When you think about stablecoins, tokenization, which is a whole other conversation, but if you think about it the next 5 to 10 years from now, this is going to be the source of liquidity. So it's almost like a self-serving prophecy to think about, your model going that way.
Yeah, I mean, I think it's going to be the most prevalent alternative payment method out there. I think as we start to think about it, I think there's going to be the usability challenges that Zero Hash seeks to solve, and that could extend, for example, to rewards. That could extend, for example, the way that we think about subscription payments. I don't want to push my payment to Netflix every month through a push payment. That's how stablecoins work today. So we're building out, for example, an ability to do subscription payments. So I think the power and usability of 24/7 instant settlement, irreversible, cross-border, an incredibly powerful technology that can be leveraged is going to be there, and especially with legislative clarity, allowing effectively every bank. And what that does is that means that everybody's going to have access to the alternative payment methods. So you open up hundreds of millions of people in the United States access to a technology overnight.
Yeah, the TM is huge. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.